welcome to this video. I'm going to be talking about the swing trading strategy for stock investing. So there's times where you might want to just buy a certain stock or group of stocks and just hold them for the long term and not worry about short-term price fluctuations with the stock. It might be a really secure company and you might not have the time to go back and forth checking every week or every other day to see what the stock price is doing. You might want to just buy, just hold it for 6 months or a year, and then check back in and see how it's doing. On the other side, there may be stocks where you want to watch them a little bit more closely, or you may not feel comfortable just putting, say, $1,000 into one stock and just letting it do whatever it does for the next 3 months without checking on it. You may want to check on it more frequently, and you may want to pull money out of that stock at certain times. So with swing trading, you're buying a number of shares of a stock today, and you know in the short term you're probably going to sell some of those shares at a profit and either move that profit to another stock, or you may want to put that profit right back into the same stock if the price dips down. So in an example I came up with, let's just say ABC company is at $100 a share right now, and you buy 10 shares of it. So you put $1,000 into it, and you notice that the stock price goes up to about 105. And you notice in the past that stock price is always fluctuating. It's always up, then it's down, it's up, then it's down. But you know, long term it trends up, and you don't want to sit through all those price fluctuations. Maybe you decide to sell half your shares at 105, expecting in the next few days the price is probably going to drop again like it always does. So at 105, you would have 10 shares, you would sell 5, counting on the fact that you think it's going to drop in price. And sure enough, the price drops to 102. So then you buy back those same 5 shares you sold before at 105, you're buying them back at 102. The price then over the next few days, next couple weeks, climbs up to $110 a share. At this point, you have 10 shares. You decide, you know what? I'm going to go ahead and sell 5 shares before the stock price dips again like it always does. And for the time being, it goes down a little, up a little, and then sure enough, it starts going down for the next few days or the next couple weeks. So now it's down to about 105, 106 again. You decide, okay, I'm going to buy back those same 5 shares I sold before, except for now I'm buying them back at 106 after I sold at 110. So you wait a few days, a couple weeks, maybe a month or so, you notice the price is up at $120 a share. You're like, okay, good, I'm doing good. Now it's at 120. I've got my 10 shares. You might want to go ahead and sell half your shares again. Now you only have 5. The price may go up a little bit, but you're expecting it may drop again. If it doesn't, hey, you still have 5 shares at 120 and the price is growing. If the price does dip again and you notice, man, it's down again to $115 a share, you can buy back with your profits that same other 5 shares that you sold before. You're buying them at 115 now. Now from 115, you have 10 shares again. You wait for the stock to grow over the next few days, next few weeks, and you notice, okay, now it's at 125. At that point, you can decide what do you want to do. Do you want to just go ahead from then on, just hold the stock and just, stop watching it so closely? Or do you want to continue your swing trading strategy and try to increase your profits? The good thing about the swing trading strategy is you can increase your overall profit. Let's say you were just buying and holding ABC company. You bought it at $100 a share and you bought 10 shares. In a few weeks, few months, you're up 25%. That's not a bad return for, say, a 6-month period to a 1-year period. Not bad at all. Let's say you were swing trading, selling high, going back and buying those same shares lower. You may have been able to get up to 30 to 35% in that same amount of time. But the only thing is, with more profit that could be coming, you also could be taking on a little bit more risk. Let's say ABC company, instead of fluctuating so much over the next 6 months to a year, what if they were doing their operations in a certain way where they're becoming more efficient, where their quarterly revenues were constantly growing and more investors were taking notice? So instead of people selling their shares and making the price go down, what if everybody in the next 6 months just kept buying that company? And the graph, instead of going up and down, and mostly trending up, what if it just trended up without many fluctuations? So you would have bought at $100 a share, you get up to say 105, you're thinking, okay, let me sell some of my shares and wait for the price to dip a little bit. Well, what if it doesn't dip? What if it does continue and it goes up to 110, 115? Then you're thinking, okay, I already sold some, what do I do? Do I buy some more? You may decide, okay, I see a little bit of a dip, you buy some more, and the price starts going up. What if you think to yourself, I'll sell some more and I'll wait for another dip? Well, what if the dip isn't really significant? You sell some, say at 115, and it only dips to 113, and you're thinking, it'll probably go down more than that. I'll wait. I'm not going to buy any right now. What if it does not dip down to say 110, 108? What if the price does from the 115 just continue to go up? Then you would have missed out. You would have sold some of your shares and the price may have kept going up and kind of like left you behind. So in the long term, if the price doesn't significantly take any dips to give you opportunity to buy back in, then you could also be kind of hurting yourself a little bit. In that case, the buy and hold strategy would have gotten you 25% in the long term, whereas attempting a swing trade but missing the opportunities to buy the stock at a much lower price, or the price just not going down low to give you opportunity, you may only get, say, 15 to 20% in this case. But the one thing about it is you will have also reduced your risk a bit, because anytime your money is in the stock, there is some risk. And anytime you've pulled some money out to kind of capture some of your gains, you are protecting some of your investment. Some of the money that you made, you've taken it off the table. It is protected, because you never know if the stock price is going to go up or if something can happen and the price can go down. So you reduce risk, but you also have reduced possibly the amount that you could make. And as always, you always have to do your research, figure out for each company that you want to own, how much risk is it holding these companies? Is it a company that's really, really secure? They've been around for 50 years, constantly just slowly growing at a constant rate? Or is it a newer company? Maybe they're just kind of getting started, they're raising capital, and they're not as stable. These are the type of things that will tell you if you want to buy and hold the company just long term and forget about it and check in once every 6 months, or do you want to check in more often and possibly capture gains when they're up and look for opportunity to buy them back when they're lower.